been a long time coming, but we're going to finally dive in and bring everything together that we've been discussing in the EOD recaps over the last few weeks and the last few months. And welcome to Order Flow Labs. And it's been a pleasure working with everybody who's here. And I'll remind everybody of the risk disclosure that's available on the site. But to begin with, these are the topics that are going to be covered. These are the most commonly asked questions and topics that are needed to be rehashed. And so we're going to bring this all together into one aspect here: high time frame distributions, the nuances of those, confluences, profiling across time frames, range understanding, leg-to-leg profiling, two LVNs back, and what does that mean? 45-degree builds, LVN return setup, ledges with LVN return, extending untested pivots, grouping pivots, absorption versus initiation, and mechanical versus emotional, or as we discussed not too long ago in an EOD recap, efficient versus inefficient. So let's dive in. High time frame distributions. So volume profiles on a high time frame serve as valuable tools for gauging potential market activity and understanding the broader dynamic. The key to effectively utilizing those distributions is identifying primary low volume nodes in relation to the essential structural elements. And so these elements are the previous week's value high, low pivot, previous month's value high and low, and manually drawn profiles from swing highs and lows. This wide range perspective, zooming out, allows you to anticipate activity such as entry points and exit points and potential rotation possibilities based upon the participants who are active at that time it's approached. When an auction enters the high volume node, that's crossing that distribution. We then want to be prepared as we complete that distribution. It's essential to remember that when an LVN is breached or respected, the previous distribution acts as a rotational aspect, and with potential pauses or participant activity to a trade around the HVN, but that LVN on a high time frame is going to have certain nuances along the way, and we're going to dive into that. Effective risk management on higher time frames involves identifying the primary LVNs to determine the rebid and reoffer opportunities due to any historical disinterest. Low volume node essentially means that there was not a lot of interest in two-way trade at that level, whereas a high volume node is where you had that two-way trade. And so this enables you to capitalize on areas there where there was lack of interest in the market, increasing the likelihood of any type of favorable outcomes. So when examining the high time frames, it's crucial to understand that this is a fractal in relation to the intraday visualization. The concepts applied to the HTF or high time frame distributions remain consistent to the low time frame, but become more immediate and actionable to you as a trader on those tighter time frames. The short time frames enable you to refine your precision based on the current conditions. So in summary, the high time frame distributions offer that insight into the activity, allowing you to identify those key structural zones and elements and effectively manage your strategy from there, not get caught off sides. And so we need to understand those aspects as we go. High time frame nuances. When approaching a structurally significant area in a high time frame distribution, such as a primary low volume node or a weekly or monthly value high-low, it's essential to consider the nuances that accompany these levels. So understanding these subtleties can help you be more effective and more precise with the dynamic of your entry and so forth. And so there's a few points I want to step on here. One is the balance and test phases. So when the market reaches a significant high time frame area, primary LVN from a wider zone, as we zoom out, it typically does not result in an immediate stop and turn on a dime and move. Instead, there's often a period of a balance and test where it pauses, two-way trade, test, pause, two-way trade, test, until you have initiation out of there, where the participants, they assess the commitment of that buy and sell activity. And this process involves determining the volume at these levels on that short time frame. So that balance and test phase, we come into a high time frame, LVN or structural component, then we want to patiently allow that uh, that test phase to show its hand in order to engage. So initiation, retest, and reversion. After the balance and test phases, the market often experiences initiation and then a retest and a movement away from the zone of reversion, zone in reversion. So initiation refers to the phase where one side of the market, the buyers and sellers, start to aggressively take control, leading a directional move. A retest of that tendency, or a retest refers to the market's tendency to revisit that area of initiation in order to confirm the strength of that move, and then finally continue on that reversion. And so when I say they show their hand, and we're going to see a ton of examples on this, but basically allowing that balance and test phase to occur, gauging for that acceleration or initiative activity out of that, and isolating where that initiation occurred for a retest in a reversion trade. So absorption and intraday observations on a tighter time frame. Absorption considers the volume transacted in the range that favors that dominant participant. So in a high time frame zone, absorption may be over a wide multi-point range. And highlighting areas where the buyers and sellers are most active is going to give that two-way trade activity, that balance and test phase. Monitoring absorption on an intraday scale is going to allow you to zoom in and see those tight time frame opportunities and potential shifts in that market sentiment, leading to a more precise decision in pressing buttons, which is what we do. So absorption involves the following dynamics across the book here. So limit orders, and we're going to cover this again towards the end as we compare and contrast absorption and initiation. But limit orders, absorption takes place when there's a large cluster of limit orders, passive participants over a price level of the book, and they represent a resting interest of traders who are willing to place interaction at that price level. You also have aggressive market orders, where, and that's when individuals go or enter position at market when a large number of aggressive market orders reach that price level or that zone where you have the limit orders absorbing. The market orders are executed against those limit orders, showing that delta that we see. And so that results in the transfer of contracts from one participant to the other. Creating what's next is an order book imbalance. So during absorption, an imbalance in the book may occur as the aggressive market orders overwhelm the resting limit orders. Okay, this can lead to a temporary pause in that price movement and potentially a reversal if the absorption then begins to initiate. So the key component here is, are we initiating out of the zone of absorption? On the volume profile alone, it can be identified as a prominent high volume node where significant trade activity has taken place. These high volume nodes are considered areas of that two-way trade due to the concentration of those limit orders. And so think about that as we step into later on in this discussion to bring everything home with the LVN return type activity, how you have a push out of a zone, we build a high volume node, and then we push away. So we see that absorption and then initiation away activity, and then a retest to confirm the strength of that activity and move away. So price action with absorption. When absorption occurs, the price action may display a slowing or stalling of the current trend. And this is because the aggressive market orders are being absorbed, or they're running out of fuel, causing a temporary shift in the supply and demand dynamics. So in summary, this is basically just simply the interaction between the aggressive market orders and the resting limit orders. And that's going to result in a temporary pause and potentially reversal based upon who steps in next. And so that's essential for understanding the things that we're going to be looking at. Now, two-sided trade opportunities is the presence of a dominant leg in a high time frame When the volume profile doesn't eliminate the possibility of a two-sided trade activity, we're going to have two-sided trade responses around each distribution. And we say two-sided trade. I mean opportunity on the buy side and the sell side as we range mechanically around a high volume node. So the natural rotations along these along the primary move and expected intraday ranges, they create opportunities for you to profit from these rotations. And so identifying, capitalizing on these shifts can significantly improve your ability to extract from the market as these mechanical aspects occur. Integrating the high time frame nuances into trading strategies. So understanding these concepts here, considering the balance test, initiation, retest, and reversion phase, as well as absorption and so forth with two-sided trade opportunity is essentially gonna open up your eyes to the distribution at hand. And so you can have exhaustion within a primary leg up that also continues up, but you have a pause, two-way balance, and resume of trade. So without continuing that there, confluence timeframes. So confluence timeframes. So understanding and applying these and profiling techniques across various timeframes are essential to enhancing the effectiveness of your profiling, gaining a deeper understanding of where you are in the auction at that time. So while profile shapes and theory are certainly interesting and a fundamental background of this, clearly I'm not teaching right now what a high volume node is or a low volume node. There's a 101 section in OFL that's going to teach that and the basics of a volume profile, but it's crucial to focus on practical application of the volume profiles in relation to the fractal nature of multiple time frames and market structure. So time frame selection and the importance of relative data. When you're analyzing a volume profile across multiple time frames, you have to acknowledge that information in a manner that respects the fact that you're looking at a zoomed out to zoomed in picture. Okay, due to the nature of the contracts and the market participants, you may be looking at something fresh and new, or maybe looking at something that was priorly positioned and not quite there. So therefore, when concentrating on intraday positioning and trades, you got to consider the prior week, consider the prior month, the overnight session, the current live build in the session at hand, because we take a top-down approach. And a top-down approach involves reviewing the prior and current months volume profiles before planning sessions to isolate those high time frame activities, get an idea where you are. I often say if you're jumping on a trampoline, you do a backflip, you need to know where your feet are going to land. And so where are you at in the distribution of those high time frame aspects? And then stepping into the weekly, where are you at with respect to the weekly? Step in further, where are you at with respect to where we were overnight coming into RTH? And then as you do this, you build a narrative, you build a picture along the way. So analyzing the overnight session, you have to examine that with the same criteria, identifying the primary LVNs, the deepest low volume nodes, determining the direction of price movement, and considering components of the prior week's value and the important MGI along the way to help paint this picture. So with practical application for individuals utilizing the volume profile like this, it's crucial to practice applying these principles in a sequential manner across timeframes without changing variables. And so earlier I said timeframe selection and the importance of relevant data. I mean, don't switch your timeframes every single week. Keep the consistency to build that structure and that systematic process along the way. Identifying confluences of support and resistance from different time frames, step 1. Recognizing patterns in volume distribution and market rotations, step 2. Developing that systematic approach by minimizing your variables to analyze and combine insights across the time frames. Continuously refining plans based upon the dynamics and the volume profile shifts because the market is not going to be what it was 5 years ago. It's not going to be what it was 20 years ago. You're going to see an ebb and a flow and an adaptation. But maintaining your variables, you'll be able to visualize that as things begin to change. In conclusion, so exploring the confluences across profile timeframes not only is going to help you with the planning aspect of this, it's going to help you with the stats of your own trades and identifying your ability to be able to capitalize on certain plans, see where things were wrong, and move forward from that. Range understanding, session, week, and month. So here I have a graphic of something that sits up in the corner of my screen. I know I want to know the weekly range average. I want to know the current weekly range. I want to know the daily range average. I want to know the current day's range. And this is all price based, but how does that help me here? So as you approach any trading session, it's essential to be aware of the relative range in comparison to the prior days or weeks or even months. While the average range for a specific day or week does not provide a definitive expectation, it can offer a valuable framework for anticipating the likely boundaries of the auction as it begins to unfold. For example, when preparing for an RTH session and observing that the overnight session, let's say, utilized 30 points of range, but the anticipated average is about 200. This information can serve as an indicator for potential expansion for your targets on either side of where you currently are in the distribution. Additionally, this insight can help traders align with the prevailing auction direction by discouraging counter-trend trading in the early stages of initiation. What do I mean by that? Let's say we have a tight range off the open. We had a really tight range off the overnight, and we begin to aggressively move out of zone. So instead of trying to assume that that's going to be a stop run reversal, you're moving and beginning to expand that range. You may be in the initiation leg, and therefore the worst thing you could possibly do is try to counter the beginning of an initiation. So this can be seen by utilizing whether it's the ATR over a period of days or weeks to show the average excursion of price activity. You can use the ATR study that we built in order to show that and how that seals on a day. You're going to see this utilized on a weekly aspect moving forward with my planning. I know we've been doing this and I've been doing it manually along the way, but now we have an adaptive approach. And so that's going to smooth things up for us, give an idea of that range. So both the weekly and daily ranges are utilized in planning sessions and monitored throughout the session to offer nuances for possible exhaustion and target levels. And in conjunction with the previously discussed high time frame profile analysis, these perspectives provide both comprehensive overview and a current snapshot of the auction's characteristics. That's going to enable you to make a very informed decision, especially when it comes to mechanical, non-mechanical. We'll get to that. But stepping into the leg-to-leg profiling. Now what you're going to watch here is a leg-to-leg profile. From the left, you see one drawn from the swing low, and then you see one drawn from the high as things have changed, and then from the swing low. Okay, so a leg-to-leg volume profile is a technique to gain a more profound understanding of the dynamics to enhance your precision. This approach entails manually drawing a volume profile from the most recent swing high or low, and that's contingent on the time frame that you use. Okay, we're all looking at different execution style charts, but you can see when that change in leg occurs, and therefore it needs to be monitored as a fresh leg of the auction. So as the market advances, auctions transpire in rotations, and that can be visualized and isolated by these rotations or by using leg-to-leg profiling in order to assess these rotations. Now, leg-to-leg profiling allows you to pinpoint critical levels along each rotation, whether it's from a higher time frame to comprehend where you are in that current aspect, grouping multiple days, grouping multiple sessions, and so forth. But ultimately, it's going to improve the accuracy and potential interaction points for two-way trade activity. When I say two-way trade activity, I mean areas that we expect response. So if we have isolated a primary LVN that we want to see move down into and see bid out of, we're assuming in moving down into that primary LVN that we would get a bid response from. But first, before seeing any response, we need to see two-way trade. We need to see absorption and then initiation. And so that is that's how this would be managed. Now, besides employing the leg-to-leg profiles for planning and execution, it's also advantageous for managing active trades. So by closely observing the ongoing build of the profile, you can gather information about the volume transacted as the price begins to go in your favor or fluctuate, and it's going to allow you to make more informed decisions regarding managing a position. Not everybody manages a position like this, and this is not the only way to manage a position. I can only share the way that I utilize this and manage positions on my end, but this approach permits me to evaluate the genuine change in the dominant leg of the auction by monitoring whether low volume nodes are being respected during the process. So in the GIF that we're watching here, if you see this come to the high, if we entered short and begin a positioning down, then I want to make sure on that leg down, I'm respecting LVNs as we go, and I can utilize 2 LVNs back to see if I have a change in that dominant leg of the auction. The next thing we're going to be talking about is 2 LVNs back. If we begin to, so 2 LVNs back, this is a principle of the auction that if it changes, or if dynamics change and 2 LVNs along the way are breached counter to the primary leg, then I like to use that as a rule of thumb to say that the current leg of the auction is concluded. And a period of balance thereafter may ensue before the next initiation. So this enables me to anticipate potential shifts in the market dynamics and adapt to the strategies. So if we breach 2 LVNs back, the first thing I'm thinking is, okay, well, now we've breached here. I would expect some sort of two-way trade. I don't want to be in that previous dominant leg, because now I would expect some sort of initiation out of the next wider balance that we're stepping into. So in summary, this is going to serve as a detailed method for improving trade position and management in the respect that we're doing this intraday. So by concentrating on the most recent swing high or low and isolating the current legs of the auction, you can acquire valuable insight to these critical levels and interaction points. And so this is going to empower you to be able to not only assist in trade management, decision making along the way, but also getting an idea if you want to get on board with the leg of a trend. So we start to move out of position or go against the trend, and we breach 2 LVNs, it starts to run. Well, if you were not positioned for that, that's fine, because now as you draw that on the current leg, you're going to start seeing areas that you can isolate and begin to interact with the current leg. So until you're breaching 2 LVNs back, then it's a go. 2 LVNs back meaning. All right. So as we were talking about, a key concept is when 2 LVNs are breached, it often signifies conclusion of the current auction leg. Subsequently, a period of balance may emerge before the initiation of the next leg. So I frequently say, if she's building volume, she's not done, which implies that as long as the auction efficiently drives in a unidirectional, one-direction manner, informs high volume nodes, the continuation of that leg is to be expected. However, when the auction no longer adheres to the prior LVNs and establishes a new leg or changes against that leg, then the alteration of that trend is imminent. So as a general guideline, if it's auctioning across 2 primary LVNs, the dominant leg is considered to have reached a potential conclusion, resulting either in an extensive balance of a newly formed zone of balance, or set up for a positional counter move. And so this is going to just keep keep you on sides for this. And so here's an example here where this is identified recently here on NQ. You see 2 LVNs back, and then from here, here's where we went from that, pushing in. Now, there's plenty of times where you'll even see something like this. Push down, and we get to the next one, and then we begin this two-way balance through here before we get initiation out of a zone. Basically, all this means is that that leg that was clean and upward has come to conclusion, and we're going to go balance to imbalance. And sometimes it just goes straight to imbalance. So this is an example that was thrown in Discord not too long ago of an LVN return trade taken, and what we saw was initiative response out of here, and we have the LVN up here, we have the return reason for entry, and as that profile is built along the way, we have this built up here as we start to breach that second LVN. Stepping out, because auctioning back into this, we can certainly traverse that zone. Just an example there. 45-degree builds. This is one that we get a lot of questions on, but a 45-degree build is as simple as that. It's 45 degrees, and so it's very clean, and it almost looks just like that. It's not parabolic into a taper, and certainly you can call that a taper because it is technically tapering, but you have an even two-way trade activity in this zone that is just dwindling somewhat down into here, and we don't have any exhaustive evidence of that move. So during the development of the volume profile, the formation of the low or high can provide this insight into the behavior, what's going on. So the 45-degree build is something we want to pay attention to. When a 45-degree build occurs, it suggests that the order flow is relatively balanced with buying and selling pressure maintaining at an equilibrium. And so when you have two-way activity and prices moving in one direction, you're not going to get a change of direction, especially if you're not breaching LVN above you. Two-way interest will continue until you have overwhelming one-sided interest in reverse. Now, the even distribution of orders often results in this smooth diagonal line, and you can interpret this as an indication that market participants are not finished yet with their transactions. And further, price can explore beyond that in order to seek exhaustion. So implications of a 45-degree build for market participants, for monitoring volume profiles on DOM, recognizing a 45-degree build is certainly crucial, anticipating potential movements, because the balanced activity, the two-way activity, is not a clear dominance or not an imbalance between the buyers and sellers. And so this can certainly just lead to a grinding, further price exploration in the dominant direction. And so this allows you to hit the brakes if you're looking to counter trend this. It allows you to wait for that exhaustive move. It allows you to see that, hey, I have continuation on this position that I'm currently managing. So comparing a 45-degree build to a parabolic taper. So in contrast to a 45-degree build, a parabolic taper signifies that buying or selling is significantly waned, resulting in a more pronounced curve in the volume profile. And that tapering includes the market, or indicates the market's reaching a potential point of exhaustion or completion. And that's suggesting potential reversal or at least consolidation by the market. So what you see on the left here is a high volume node built. And so I did that because you can also see exhaustion in a significant absorption that immediately responds back above. And so 45-degree build, two-way trade, we want to see more of a parabolic or an HVM build, boom, that we immediately slap back above. And we need to recognize this on a day-to-day basis, because there's no clear sign of counter initiation. It's two-way trade. So We want to look at this for continuation against that primary LVN that is either above or below us. Now into the nitty-gritty. LVN return setup. So here in this example, you're going to see this reset here. Then LVN return setup. So gaining a thorough understanding of this is paramount to what we're going to be talking about a lot. So the LVN return setup typically emerges during a potential exhaustive move in the price activity, is characterized by a small high volume node, like you see there, and it's met with an initiative counter auction. So the formation of the LVN and emergence of the counter auction is important. Initiation of the LVN occurs when that small high volume node forms, resulting by a swift, decisive counter initiative auction. This price action quickly pushes through that LVN, leaving that little distribution behind where it originated from, highs over the lows, but this is something that should be looked at on the edges of the profile. Some of the dynamics of the price activity. As the counter initiative activity occurs, price swiftly moves into the prior distribution. When it returns or comes back to test the strength and the conviction of that initiation, that's where positioning occurs. We can take a look here as this initiates out, and so that yellow arrow currently down here is where positioning should be occurring with risk against the high volume edge or the high volume node. In testing back into this to then cross the distribution and change leg based upon this being an exhausted point. So in executing the LVN return setup, you must manage risk effectively by placing a stop loss at either the HVN or the high volume edge, or if it's a set amount of points, if that's a very tight zone, you can have your whatever your risk management set is, but this is going to allow you to really tighten that up against that distribution below, because if you begin to auction down into that distribution, you're finding more two-way interest, and two-way interest can certainly mean consolidation. So this specific setup occurs frequently throughout the trading day. I mean, you can see this, especially on a leg-to-leg profile, it's going to occur, 3, 4, 5, 6 times a day, and also allows for minimized risk. First thing we need to be doing as traders is managing risk. And so to fully comprehend this setup and the manifestation of the volume profile, you have to analyze the dynamics of what is happening with price. And so we're leaving behind, after absorption phase, we're seeing an initiation, we're seeing a retest, and then a reinitiation. Here's an example, as discussed in the Discord, of initiation out of that build, push back in, test, and then a run from there. We see plenty of these here. Show a few examples. This one we looked at before, but basically we had absorptive activity down here, push in, hold LVN, and move out. This one here, small volume node, but it was a very swift and violent response up and out of this before the retest and bid from there. And then down here is an example of application. And so you see this high volume node, we see the push out and the retest, and then there are plenty of times where you're going to get multiple retests and the opportunity to either reposition if you're putting back on after meeting a 2R or so forth. But in managing that, simply you don't want that. You can manage risk cleanly against the high volume edge below you or the high volume node. Now, ledges and ledge setups. So here's an example of a ledge. A ledge in the volume profile is characterized by a sudden halt in price activity. So it's going to give a large shelf of volume without any excursion beyond it. It's exhaustion. This formation typically signifies temporary exhaustion, but those traders often what you see as a large area of attempted absorption, but that's against an unfinished auction. So When a ledge is breached, it's crucial to observe the volume build beyond that point of the ledge to ensure that price respects that ledge, because now that price level becomes the line in the sand. This means that if the auction doesn't cross back through that ledge, there's a high probability that the leg will no longer continue. So simply, let's rephrase that. When we see a ledge, we breach and build volume. If we hold underneath the ledge, for instance, like this example, if we do not get back above that ledge, we're going to continue. We get back above that ledge, we need to reassess in the same aspect of an LVN return play. In its entirety, it represents the absorption of the initiative participants. So while resolution of the ledge does not necessarily need to be immediate, it does typically clear quickly. So how do we trade this? How do we effectively manage risk? So when you enter a position against the ledge, because you enter a position in the direction of the ledge means continuation. If you get long and you see a ledge on the low, time to cut that and reassess. But in positioning for a ledge, you're looking for the same aspect of the volume profile that we talk about frequently, which is a primary LVN above, okay, if the ledge is on low, looking for a respect of that LVN in order to position and counter into that unfinished auction for completion of the auction. So since that level upon moving through the ledge serves as a critical point, and given that positioning should be established prior to the ledge, leading into the ledge, you can manage risk a little bit more flexibly. So such as adjusting your stop in front of entry, especially if you're well behind the ledge, knowing that if the ledge as a line in the sand gives up, then you can gauge that little zone to see if it can reinitiate or not, but you don't have to sit on it to allow it to push up to the LVN that led into it. So this nuance of understanding ledge formations and risk management enables you to precisely gauge continuation, as far as if you enter a trade and you see a ledge that's not in your favor, you need to respect that. Or if you see a ledge formation occur, allowing price to return to a primary LVN that preceded the ledge in order to position and continue that auction through the ledge. Now, thorough analysis of this type of activity will begin to display itself day in and day out. You're going to see ledges. We saw them several times over in the last few days. But if the ledge is respected and you've already traversed, if you're below the ledge and it's respected in the same note as an LVN, it cannot be traversed, then that leg is going on continuation. However, if it gets back above it, that's a line in the sand and signaling a change of hands. And this brings us to a ledge with an LVN return. So if you see a ledge like this during a trading session, when a ledge is formed on the profile and it's subsequently breached, signaling an attempt at continuation, you need to be aware of the possibility of a counter trade, okay, if you're not positioned or if you're managing a position, and how to see that. So here's how you see that. The counter trade can manifest as an LVN return setup on the current session's build. So as price pushes down, breaches the ledge, creates a high volume node, pay attention to it, respecting that line in the sand. And so with price action retracing its steps through the ledge's established threshold, and then creating that LVN return as well with this, that specific interplay is a pretty powerful setup and enhances the likelihood of a counter trend move that results in an opposite leg auction that can be a little bit wider than you would expect. And so with a ledge formation, consider the amount of positioning here. We push out of this, this would be what it looks like. So you push down through a ledge and you build into a node here and auction back above, retest that line in the sand and hold. that's when fireworks can start hitting, because you have so much participation on that downside, that added fuel to push this through the ledge. A lot of sell side activity, and therefore you can start offsetting stops, which could then bring in buyer interest, seeing prices moving away from their expectations. Breakout build with RVol. Breakout build with RVol. If you haven't checked out the RVol blog on the website, please do. Guiding intraday strength with relative volume. And there's a lot of different takeaways in that. And instead of diving down through that, because that's not specifically, volume profile for this, I want to make it very clear that we talked about ranges, and those ranges can go a bit further than we expect sometimes. So having the understanding of RVol will also help guide you in a breakout scenario. Instead of trying to mechanically counter trade that, we might be wanting to get on board with those LVNs that it's respecting. Certainly you shouldn't be counter trading if it's respecting LVNs at all. But as you see R vol increase and then price begins a unidirectional movement, then that should be speaking to you. Please check out this blog. Leo did an excellent job of diving into that, and you're going to have plenty to chew on there rather than me dive into that here. So extending untested pivots. Extending untested pivots. Untested pivots, or those that have not been tested beyond their specific trading session, may act as equilibrium points or areas of interest for two-way trade or balance. These zones can be perceived as potential targets or locations for positioning, depending on the market activity when you reach them. So first off, we want to see that two-way trade, because upon reaching that two-way trade, then we have a certain expectation of initiation from there, which we can gauge on our current profile build and with the execution tools that we have at hand relative to the big picture, okay? So as with any structural element, determining which side initiation takes place is crucial for capitalizing on this, but specifically for rebid and reoffer opportunities. So allowing price to either target into an untested pivot, find two-way trade, and then show its hand, find the initiation, get on board with either a rebid or reoffer opportunity, you're going to see interaction like this across the board with your planning charts. They're going to act as magnets. They do on the intraday, and they will even on the big picture as that area of value and equilibrium grows through. So this is just an example of how these untested pivots can interact along the way. We can see even way back here, we come up, test, and we get that there. So is it perfect? Absolutely not. But the kicker here is you want to see two-way trade. You want to see a balanced equilibrium. You want to see responsive activity, a pause, tag, pause, and then initiation out of a zone. Tag, pause, initiation for rebid out of a zone. So extending untested pivots is something that we talk about quite a bit. But once the pivot's been tested outside of its originating session, it's considered to be fully auctioned, and subsequently, it's no longer a focal point, at least for my planning phase. And so this understanding of that is crucial moving forward. You want to find the ones that are standing alone in order to then begin to pay attention to, especially in the intraday sense. Grouping pivots. All right, so the Job pivot high and low offers a visual representation of that time framing concerning the value distribution formed during their development. Areas of overlapping values signify balance, while gaps in the value indicate initiative attempts. When organizing pivots, which will soon be automated here at OFL, it's crucial to recognize that the most recent pivots provide the most pertinent insight for us as intraday traders. Nevertheless, maintaining the drawn zones that are left behind can help us if we begin to escape zones, come into areas that we haven't been in a while. For planning purposes, as a general guideline, is to consolidate overlapping zones over the last, let's say, 15 sessions for boxes to see what's overlapping. Let's say over the last 15 sessions. It's not perfect. If we consolidate for 15 days, then yes, we begin to tighten that up and but use those most recent time frames. But as a general rule of thumb, let's talk about those last 15 sessions and see what's overlapping. And that way we can easily discern the broader picture of prevailing balance and short-term dynamics. So by examining the Job pivots in an overlapping sense like this, alongside of something like the autoplot balance zones, now you really start to paint a really good picture of where you're at. And as you move away from a zone, you start to see the possibilities of a leg that's beginning. Okay, that's grouping pivots. An example of older pivots down here, if we haven't been in that zone in a while. Okay, so as we get there, what are we seeing? We know that we have a previous area of balance. Are we going to get two-way trade activity? Where are we actually looking? Well, we'd be looking, in this case, where we'd expect that two-way activity. So down in here. If this comes into this zone, we'd be looking for reoffer potential to traverse prior zones. And obviously, we have other market generated information along the way we can utilize. And so pitting this together is going to help us paint that picture. Absorption versus initiation, probably the most common thing that's asked about. And so here's a simple little graphic as we begin to talk through this. So the auction rotations consist of two primary components, absorption and initiation. Absorption occurs when participants attempt to establish positions, while initiation transpires due to aggressive participant interaction, and that accelerates price movement. So absorption specifically entails the following dynamics. With limit orders, it's going to occur when significant concentration of limit orders buy or sell exists around a price range on the book, and that represents resting interest from traders that are willing to participate at those zones. Aggressive market orders on the absorption side, the absorption process commences when numerous aggressive orders, buy or sell, enter that zone of the limit orders, and they execute against the limit orders, transferring contracts between participants, but they're not making progress, which can lead then to an order book imbalance. So absorption can cause that imbalance as aggressive orders overpower or continually fill those limit orders. And so this is at least going to lead to a temporary pause. In that temporary pause, you are seeing absorption, especially with on the book, such as the limit orders, you're seeing replacement and refreshing of those limit orders. What we want to see from there, from that absorption, is the initiation, is the aggressive side that is getting caught like a catcher's mitt, running out of bullets? Or are they able to continue to push that aggression through and continue that direction? So when we begin to see this two-way trade, and we're talking about this with the profile and LVNs and so forth, we start to see that catcher's mitt response, that the limit orders coming in, stepping in, catching all those aggressive orders. And initiation from absorption would mean that after a certain amount of participation takes place, then instead of resting with limit orders, you see the limit orders stepping up or hitting market against what you were previously seeing come through the tape. Absorptions identified on the volume profile as a high volume node where substantial trading activity transpires. Think about it. You have resting limit orders that are repeating and refreshing. And so as the aggressive market orders are stepping in and filling them, you're building volume. So this is often considered as an area of two-way trade based upon that high concentration. We talk about rotating around a high volume node. But price activity during that absorption is going to be slow. It's going to stall. It's going to put a pause to that dominant trend as orders make no progress. And this creates that, that supply and demand equilibrium until we get an imbalance and one side overtakes the other.
As far as initiative activity, limit orders during initiation often become a little bit scarce, creating a potential imbalance in who's stepping onto the book. So you see initiation out of absorption, you're going to start to see pulling on the other side. Whereas in the aggressive market orders coming in, instead of being previously those limit orders, are now going to be the ones hitting the book, and the resting orders from the prior leg are going to be lifting. That's initiation. So aggressive market orders would be large quantities of market orders pushing price movement through previously untested levels or LVNs where it was accelerating before. The prior imbalance is reversed. And so instead of having, think about footprint, you have a huge sell imbalance on one side. They're making no progress. Price stalls. It begins to push away. And then all of a sudden you see buy orders hitting tape and aggressively pressing in as it breaches an LVN and flips and accelerates away from all that sell side delta. So the prior imbalance is reversed and spread in direction as price participants flip side of the trade. With respect to the volume profile, we're talking about LVNs, traversing LVNs, because this price action is rapid and decisive in a particular direction, reflecting the imbalance of the participants. So counter moves to initiation are very slow. You can have a counter move during initiation, but it doesn't make much progress, and it's pretty much just a pause. We don't want to position, especially counter, during initiation. We want to gauge that two-way trade. This is why we isolate the LVNs. This is why we isolate those zones of activity. We want to see balance and then gauge the initiation response and stepping in the trade. It's going to help us stay on sides. So comparing and contrasting absorption and initiation. The key difference lies in the speed of the auction and the price action. So absorption is characterized by slower price movement and stalling and pausing, as resting limit orders take in the market orders. And in contrast, initiation is marked by rapid, decisive price movements driven by aggressive shifts in balance between the supply and demand during that auction. Mechanical versus emotional auctions. Last two EOD recaps, these were discussed, but a mechanical and emotional auction activity offer a systemic, or that understanding of these two offer a systematic approach to evaluating trade interactions. It allows you to decide whether you want to engage in such a session or not. Mechanical auctions also have been referred by me as inefficient, and emotional auctions referred to as efficient, to help you understand the effectiveness of that unidirectional auction. Think about this. Mechanical, if we're rotating back and forth, then that primary leg is not efficient. If we have an emotional auction where we have no rotations, it's a very efficient auction, just moving. Okay, so a mechanical auction or an inefficient auction is characterized by auction rotations occurring at levels of whether it's MGI, market generated information, or pivots, or VWAPs, or value areas. Anything that we're gauging as areas of interest is market generated information. And so identifying whether or not to participate in the counter auction following what we're seeing is going to be determined by whether or not we're breaching back through these zones. So if we begin the auction, and we start traversing two LVNs back, and then we auction down, and we do that back and forth, then it's considered mechanical. You have to be able to define what mechanical is in order to then be able to stay on the right side of a trend day, okay? In contrast, an emotional auction or an efficient auction features a consistent continuation, volume build, respect for primary LVNs, and further continuation without breaching preceding LVN activity. And while temporary pauses around MGI can be observed, the counter auction or initiation around those zones is gone. It's not there. It's lacking. So recognizing this early in the session, rotations or the inefficiencies allows you to adapt your strategy very quickly for mechanical responses And it allows you, and by following the initiative participants lead, preparing for rebid, reoffer activities, you can optimize your approach, stay on side, okay? Um, Now, drawdowns in understanding this type of stuff are going to be significantly lower because you're not going to be counter trading if you're efficiently building and expanding, building, respecting LVNs and going. So in a unidirectional day, there shouldn't be anybody being blown out. And so we need to be able to apply this. So what is mechanical? Let's say we push up and we build back, and let's say something like this. We push down, we build back through some LVNs, then we already see pretty much off the bat that it's becoming mechanical. Because otherwise, if it was emotional unidirectional, we wouldn't have gone and traversed and come back into the mix. And what does that mean as far as us intraday traders? Then we start looking at zones. We start looking around this as an auction that is potentially finite on the session and engaging appropriately when we see that response, whether it's a reoffer from zone. We see initiative response back in, rebidding from where that initiation occurred. We see offer here, building in with previous highs. We want to take that high out and for a stopper and reversal. High out, stopper and reversal back into pivot. Those types of mechanical moves are what I'm talking about, whereas it's not something you can put into play when you have a balanced zone, okay, a tight auction, and then a push, build, push, build, push, build, and you're respecting all the LVNs along the way. You cannot counter that. And so it's not until that time frame changes or we start breaching to the other side that it becomes more mechanical. So when it does, then first you're thinking, like we talked about at the beginning, balance to see who seeks initiation from there. So summary, finding structural levels with order flow based analysis, volume profiles, identifying high quality execution opportunities. You want to be able to manage risk, have defined exits, LVN returns, ledges, things like that, understanding initiative and absorptive activity. Thinking about the top-down fractal sense of looking at profiles and reducing your screen time with automation. And so as these things come into play, seeing things occurring such as the dominator and the EAD, helping to speak to that initiative process while you're looking at this along the way. Knowing the difference between efficient and inefficient auctions, keep you on side. Avoid those handful of days that wipe out 2 weeks of work, that type of stuff. But the biggest takeaway is be patient while you're developing your process. Take time to review the content that's available here. And although it can be cumbersome, reach out if you need help or direction. Glad to do so. I appreciate everybody who's been stepping on for the different Zooms and interacting here in the Discord. It's a pleasure to work with you guys. Let's continue this and just keep knocking it out of the park. All right.